This is the MBK Beat with Mark Kashevsky from MBK and Associates, Inc. Your place for finding all you need to know about life insurance and how you can get more of your money. Recorded live here in Buffalo, New York, it's time for the MBK Beat with Mark Kashevsky. Hello, folks, and welcome back to the MBK Beat with Mark Kashevsky. It's the 13th total episode and the third episode of the case study series, where we break down some of the plays of the playbook, but in a lot more detail. And with that, I'm going to turn it right over to the expert here, Mark Kashevsky, and ask you the big three questions we're going to answer on all these case studies. What's our topic? Who's our audience? And how does it work?
Well, good morning, Jeremy. And our topic this morning is corporate-sponsored group life insurance plans. And our audience are really successful business owners and professional groups that are looking for some additional tax relief and tax-favorable retirement benefits. And how does it work? Well, I'll get right into it. And then we'll go through an example. Eligible employers are C corporation owners that can establish these plans under the tax code. Now, if you're not a C corporation, for example, I am a C corporation, but a lot of my clients have S corps. What they can do with their accounting firm is establish a employee management company, which is a C corp, which is done a lot with service corporations, and use that structure to cover employee payroll, related benefits, and employee expenses. And then you have a C corporation that will qualify for this benefit. Eligibility rules to get into the plan require you to be a full-time employee, and under the code, full-time employees, an employee working at least 30 hours, and you can keep people out who haven't been there for 3 years, age 21. And anybody who meets those requirements will be included in the plan. Now we can establish classification of eligible employees. For example, Class 1 can be the executive or management group. Class 2 can be everybody else. I mean, you can have 3 or more, but typically we're dealing with smaller employee groups, so it'll be 2 employee groups. The executive management group that we're trying to target, and then Class 2 will be administrative and other employees. Now, once we establish the plan and who's eligible and who we're targeting and who has to be in the plan, we're basically reverse engineering the benefit based on a target contribution or a benefit that we're trying to achieve for the management group, for the owner group. The plan then develops an insurance benefit based on that as a multiple of everyone's salary. I don't want to get into those weeds today, but you'll see when we see an example what that looks like. And then all the employees that are covered, whether you're in the management executive group or the administrative other group, you all have a group insurance benefit that's a multiple of salary. And everybody's offered a permanent benefit that they can elect. The employer will pay for it for everybody. This is a fully employer-paid plan. And for the administrative group, we typically offer them a term benefit for the same amount or a reduced default third option. And why do we do that? Well, what happens with this plan, the corporation will pay for the cost of the benefit. It's a corporate deduction. But on the permanent benefit and on the multiple term benefit, there's a tax cost that has to be imputed to the participant. And what we find is that most employees, if they have to pay anything for this type of benefit, they don't want to do it. So, but the government does allow a default of $50,000 group term life benefit that the employee can elect, and there's no tax cost. And that's typically what most people in the administrative or Class 2 group will purchase. Now, these plans are fully funded after 5 years with very specialized insurance contracts that create the maximum tax benefit, not only for the corporation, which is a deductible cost, but minimize the tax cost for the executive or the employee that's covered. The payoff in this arrangement is that at retirement, the money comes out tax-free income for life, because we're using an insurance contract to fund these benefits with high cash values. And the best way to go from here is really to look at an example.
Perfect.
Okay. So this is a summary, and then I have a ledger illustration that shows it year by year. But just to give you an idea, what we have here, on this is a physician group, 45-year-old male, and he wanted to put away $100,000 a year. This is a surgical specialty group, three physicians all making significant income, and they're maxed out on their qualified plan contributions. They had a 401k with a profit sharing option. They were maxed out at roughly $50,000 each. They wanted to put more money away, and they didn't want to get into a defined contribution arrangement. That was a little more complicated than they wanted to do, but we were able to show them the three partners each could do $100,000. And actually, one of them may elect, this is in process, one may elect to do a reduced amount because he's got some tuitions coming up. So we have that flexibility. But anyway, Dr. Lee, for example, and that's a made-up name, we're putting in $100,000, and it's going to be over 5 years, that's $500,000. Now, based on a formula in the tax code that's applied to the contract that's designed to fund this, he's going to have to pick up on a 1099 $272,000 as imputed income. Now, he doesn't get the money, which is significant. He's only paying tax on the money. And in the tax bracket his account told us to use, his tax bracket, it's going to cost him $109,000 to get the money out of the corporation. That's pretty tax efficient. That's the only tax that's ever going to be paid on this entire benefit. Now, when he goes to retire, we're going to be able to fund, through this contract with Pacific Life, almost $150,000 a year non-taxable income to age 100. That's the equivalent of taking out $250,000 out of a qualified plan. And if you figure out what you'd have to put into a qualified plan to take out on a minimum distribution basis, you're talking about having to put away over $5 million in a qualified plan. We're putting in $500,000 to get the same result. It's really, really efficient. Now, this also provides a death benefit, and this benefit turned out to be about between 4 and 5 times his W-2 income. This deposit generates this death benefit. So it was 5 times his salary. That was the plan. Everybody got 5 times their salary. So that's how we reverse engineer that. So if we take this out to age 100, the death benefit, by the way, will go down once we start, taking out the money, because we're going to take out $5 million. We have a death benefit that's still payable at the end of the term here. We have a tax savings of $151,000 on the money he didn't pay tax on. Over the lifetime of the payout, as opposed to a qualified plan, we've saved over $3.5 million in taxes, and we saved some payroll taxes, and there's also an additional uplift on what he gets out of the contract when at retirement, based on how the distribution pattern, which has to do with the payout provisions. When we add all those numbers up, though, we've got about almost $10 million of benefit coming out of here. It's pretty dramatic. And the internal rate of return on this is pretty substantial too. It's over 13%. Now, let me show you what the actual numbers look like. This is the actual Pacific Life illustration for an indexed universal contract that's front-end loaded, funded, designed to fit into the tax code for this plan. And we're illustrating here at roughly 6.1%. This contract is actually averaged about 9.34%, and that's in a so we can't illustrate that though. And the additional benefits include some I don't want to say supplemental, but in addition to our performance outstripping illustrations significantly, we're talking about a contract that can provide additional return contractually under the contractual provisions. For example, I have a contract like this myself, and it's in an index account. I'm in a 1-year, what's known as a high cap index account. It's tied to the S&P. And my account, my cap last year was 12.5%, while I earned 12.5%. I'm trying to get 6% on this contract to do exactly the same thing. So 12% is going to get me a lot more. But on top of that, I have an option to double down on the options package. The 12.5% return was based on an options package that Pac Life purchased from the earnings on my cash. But I can elect to double it and pay for an additional option, which I did. So I got another 12.5%. And so after I reduced what it cost me out of my cash to buy that, I netted 22% last year. So that's what I mean. We're showing a 6% projection. The historical performance over the last 20 years has been much better, but there's opportunities to create additional return during your working lifetime. And then after lifetime, there's an additional uplift provision in the contract, which we slightly made reference to on the first page, that creates additional return. So there's a lot of upside here. And the downside is zero. In a bad year, you get zero. You can't lose here. So these numbers are assuming 6.1% without performance, without any additional leverage with another options package, without any additional return after retirement. So 5 years, the money goes in here. There's a big death benefit. Ultimately, we will reduce the death benefit when we can, because we didn't do this to buy a lot of death benefit. We bought it to buy retirement income and create some tax efficiency. As soon as we can contractually reduce the death benefit, we do. It goes up anyway over time, and it fluctuates once you start taking the money out. But once we start taking the money out, it'll go down again. And this goes all the way out to age 100, and there's still a death benefit. So it's a very, very attractive benefit. It's very efficient from an economic and tax standpoint, and it's extremely simple to administer. We have a third-party administrator that does the calculations on the design side, and that also will do the actual tax calculations for the CPA. And at the end of 5 years, it's all done, and it's all fully vested from day one, and each participant owns their contract personally. You're 100% vested from day one. So easy peasy Japanesey. Okay. Now, this is just a good, summary. We can, if you have a C corp, as a business owner or professional, you can do this. It's fully tax deductible as a business expense. There's really no limit here in terms of the $50,000 qualified plan limit or 401k limits. The limitation is really based on salary and a multiple, how it fits into the, does your salary allow you to put the money where you want to do it based on the formula we have to live with. But we have those parameters. They're practical parameters, but there's no legal, limitation. This benefit is also protected from personal creditors. We have a qualifying employee provision that the Treasury makes us include. We've talked about that. We use this product in a lot of corporate insurance situations. There's no loss here. It's a really, really favorable program. I could go on and on and on, but we've pretty much told you about that. From a tax standpoint, the taxation, we have a 5-year design. It can be as little as 4, as much as 7. It all grows tax deferred. The income is non-taxable when you want to take it, not when the government tells you to take it. There are no early withdrawal penalties. Anything that isn't used up, there's always going to be a death benefit to a beneficiary. And you can still have a qualified pension plan with this. That's my story, and I'm sticking to it.
Yeah, that's really, really interesting. Now, this example obviously being somewhat in the medical field, what are a few other industries that you've seen this work for?
Well, a lot of service industries, manufacturing industries, and the typical. This is your professional groups. They've got the income juice and revenue to do something like this.
Right.
These numbers, but I do a lot of plans for $25,000 a year, $50,000 a year. Minimum contract purchase for this is $25,000 a year, which is a good point. But I've gotten several of those, and 50s, and then you typically, and these situations I'll typically find through a CPA firm who's doing the the tax work, and how can I save taxes? How can I
Right.
save taxes? I'm paying way too much in taxes. I can't put any more money into my qualified plan. I have to take money out of my 401k plan. And it's going to get worse with the new tax law that's coming.
Right.
They're going to put more restrictions on qualified plans, Roth rollovers. People making money are going to have a more difficult time sheltering money.
Which we talked about during the tax tsunami.
Yeah, it's we'll see what
Starting to see a little sign of it.
We'll see what Nancy Pelosi gets through the door, but this has not been affected. The tax favorability of insurance contracts has actually been improved. In the last one of the PPP laws that was passed actually allows us to put even more money into these contracts than we were a year ago. So it's a good day to be doing this.
Yeah, it certainly seems like it. And again, if you have any questions, please reach out, mbkinc.co. You can work with Mark. He's obviously seen it, done it, and I think that it would be extremely beneficial to you out there to go back, listen to some of the other episodes. If you have any questions, though, Mark, where can they find you?
MBK Inc. or
mbkinc.co. What's
.co.
your phone number?
716-855-1600. 716-855-1600.
Perfect.
Except on Sundays at 1 o'clock. Go Bills.
Go Bills. Thanks, Mark.
Yeah, thank you, Jeremy. Have a great day.